Hi everybody, my name is Jeff O'Brien. I'm a financial advisor with the Noble Group. Today I'll be answering your money questions from Quora. All right, is it time to take money out of stocks? Yeah, so we will all feel like this every time the market starts getting choppy or every time we see some headlines in the news that make us feel a little apprehensive about where we're headed. But in reality, I'd say if you don't need that money in the next 1 to 3 years for some sort of expense, it probably isn't a good idea to take it out of the market. Some people do this because they think the market is high and due for a correction, but markets can consistently hit new highs for months or even years before dropping significantly. And people who play these kinds of timing games rarely end up benefiting. Okay, next question. How can you use debt to make money? All right, so debt can be used to make money in many different ways, but it all boils down to one relatively simple concept. It's called interest rate arbitrage. It doesn't sound simple, but all this means is you're borrowing money at a lower rate than you're going to turn around and use it at, right? And this could be you lending it out to someone else at a higher rate, or it could be you investing it somewhere that's going to yield a higher return. Either way, the difference between what you borrowed that money at and whatever you're getting in return is net gain for you. And it can be a very effective way to make incremental gains through your lending. The most obvious example, the most common example of this is for folks who have mortgages, especially if you were able to get a mortgage at a pretty low rate. So let's say you got one a few years ago at 3.5% and money market funds are paying 4.5%. If you have $100,000 in mortgage balance and you have $100,000 sitting in your checking account or savings account, you might go to your financial advisor and say, hey, I want to pay off my mortgage. I can be completely debt free, which is a great feeling. And a lot of people, that's something that they really strive to do. But I push back on my clients and I say, well, wait, what if you took that $100,000 and instead of paying off your mortgage, you put it into one of these money market funds, which is paying 4.5%. And that difference between the 4.5% money market fund and the 3.5% mortgage, 1% on $100,000 is $1,000 per year that the money market funds stay at that 4.5% rate. So by doing nothing, not paying off your mortgage, simply putting your money into one of these money market funds, you could be potentially making an extra $1,000 a year. And that's just the most common example. Obviously, there are some other ways that you can do this, but I think for most people out there, this is what comes up the most with my clients. And it's been one of the easiest ways to add a little bit of extra money to their balance sheet year over year. All right, what happens if all Americans banded together and refused to pay taxes? Okay, so that's a good question. That would be interesting for sure. Really, everything funded by the government would cease. So you can think about road construction and maintenance, community services, medical care. If employers no longer decided to send in money for FICA, then Social Security will stop, Medicaid will stop, Medicare will stop. We'd have no more military, no more public schools. Things would go very badly very quickly. The positive, all of our politicians would no longer have jobs. I kind of like that idea, but in reality, the society that we all know and mostly love would fall apart rapidly. We wouldn't recognize it after 6 months or a year of that kind of lack of support financially, because it takes a lot of money to take care of all these things that a lot of us, we just kind of take for granted every day because we don't see everything that goes into the process of maintaining and implementing a lot of the things that we enjoy as American citizens. And yeah, I don't like paying taxes any more than anyone else, and I like to help me and my clients use tax efficient strategies to maybe reduce taxes where we can. but in general, those taxes are really essential for having a high functioning society and for a lot of the goods and services that our citizens rely on. If both inflation and deflation is bad for us, why can't we just let the prices stay where they are? Okay, good question. Yeah, so it's not that inflation is bad for us. It's really a matter of most of us don't like paying more for something that we paid less for a year ago, right? That's kind of a natural human reaction. But inflation is an important part of a healthy economy. When inflation gets too high, however, it can be very painful, very disruptive to normal economic functioning. We saw this a little bit in the aftermath of COVID-19, and we're still feeling some of the consequences of that rippling through the economy. And because of all the headlines commenting on how bad that inflation was, many people simplify the concept to inflation is bad, right? And that's all we know. But in reality, it isn't that inflation is bad, it's that balance is good. And when inflation strays too far outside the bounds of what is considered healthy for an economy, either too low or too high, it can be disruptive and harmful for large sections of the economy. Now, the Federal Reserve targets an inflation rate between 2 and 3%, meaning that's what their data suggests is healthy for a long-term average inflation rate. If inflation is too low, then it disrupts the time value of money, which most of our financial system is built on. If inflation gets too high, it can cause severe problems. The most classic example of this is in post-World War I Germany, where people needed a wheelbarrow full of German marks to buy one loaf of bread. But that's a really extreme example. More recently, what we saw is in the last few years, prices for kind of basic everyday goods started going up 10, 15% in some cases year over year. And that really starts to eat into our budgets and things that we once could afford very easily become a little bit too expensive and we have to learn to go without. And some of these things never return back to their normal prices. So it's really important that if possible, governments stay within some sort of healthy band of inflation so that the economy can continue functioning normally and so that people can afford buying the things that they need to buy without undue stress on their budgets. Before we move on to the next question, I just wanted to take a moment to let you know that you can get a personalized video from us covering your own finances. All you have to do is click the link in the description and we'll review your financial situation in a custom video recorded just for you. All right, back to the video. What is the right time to invest money in the stock market? Yeah, this is a popular question, a common question, and we all wish we could get the money in right at the low point of a correction or a crash. Of course, very few people are able to do that. For most of us, early and often, right? As early as you can afford to put money into the market, do. And as often as you can continue contributing to your investments, that's probably going to be a good idea. And the reason for this, especially the early part, is because of compounding interest. And one of the most important factors in compounding interest, one of the things that makes it as powerful as it can be, is the time component, meaning the more time you give your investments, the more of an exponential growth you can potentially see on those investments because the gains you're seeing year over year aren't just the gains on the initial money that you put in, it's the gains on the gains. As you stack up a lot of years of potentially good returns in the market, you're getting a huge uplift in your returns through that compound interest effect. And this is one of the strategies that a lot of people have used and relied on to amass significant amounts of wealth to fund their retirements and their lifestyles. Are penny stocks worth the risk? So this is a tempting opportunity for a lot of people when they first start out investing, because they think, hey, if this stock just goes up by a few cents, that's a tremendous gain for me. But the problem with penny stocks is they're much more similar to gambling than actual investing. And there's two main reasons for this. One is these stocks are traded over the counter, right? Which means they're not traded on traditional major exchanges like the New York Stock Exchange or NASDAQ, which you've probably heard of. To be on these exchanges, companies have to file a lot of rigorous paperwork that gets scrutinized by the governing bodies to make sure that everything is in order. And while they can't catch everything, usually this weeds out a lot of the bad actors. Over-the-counter stocks, penny stocks, on the other hand, they don't have to go through this rigorous screening process. And therefore, it's much more of a mixed bag as far as what you're actually investing in. Now, the second big problem is because these are very, very small cap stocks, meaning they are not traded very much, they have very little volume, they're very small companies usually. You have what's called liquidity issues, which means when you want to go get your money out, either you're not going to be able to in a timely manner, or the process of you trying to get your money out will actually move the stock significantly downward, meaning you may think you're withdrawing your money at one price, but by the time you're actually able to liquidate the money, you sold out at a much lower price. And it's just, in my opinion, these are not investments that are worth the risk. There's much better places to put your money that offer a much better balance of risk and reward. Should I max out my Roth IRA contribution if I know I'll be in a higher tax bracket when I retire? In this case, yes, it would be extremely beneficial to max out Roth contributions now while you're in a lower tax bracket, so that that money that you're putting away is getting less of a tax hit taken out of it. You will be able to let that money potentially grow tax-free between now and retirement. And then when you take it out in retirement and you're now in a higher tax bracket, all of your withdrawals from that account, assuming you follow the rules, are completely tax-free. What is the difference between mutual funds and index funds? This is a great question. Mutual funds, while sometimes used as kind of a general term that includes index funds, are typically different. Mutual funds were first created to be actively managed, which many of them still are, which means you have a team of portfolio managers and analysts who look out into the investment universe, and they're trying to find what they believe are going to be the best stocks out there for either upside participation or downside protection or a combination of the two. They typically are not going to look like an index, and they're going to have a little bit of a higher expense ratio, sometimes a lot higher, which is something that if you're going to invest in these products, you really want to know what are the fees associated with it and what do they really invest in. Index funds, they simply find an index, whether it's the S&P 500, which is probably the most common one that you've heard of, and they buy whatever stocks are in that index in the proportion of that index. So you're essentially matching the performance of whatever that index is, no better, no worse, except for whatever the expense ratio is, which in these funds is typically minuscule. In fact, you can find some that are almost zero. An index fund will be exactly what the index gives you as far as a performance goes. That a mutual fund does give you the chance to outperform, but it also gives you the chance to underperform. And so as an investor, this is not good or bad. This is just simply something that you need to be aware of before you invest to make sure that this is what you want to sign up for and that this is what meets your objectives for your planning. One last thing I'll say about mutual funds is a lot of times people in my position will get some sort of incentive or additional compensation, commission to sell mutual funds, right? So part of the expense ratio that's included in their fees is meant to be carved out and sent back to the financial professional for selling that fund. My opinion is this is a bit of a conflict of interest. You should be aware of this and ask your advisor if somebody is trying to sell you one of these products. Be clear, just ask them, hey, what kind of commission do you get for selling this product? Not that there's anything wrong with that per se, but there could be a conflict of interest. And it's just something that I always prefer be out in the open and that the client knows about it before we proceed any further. What is the IRA distribution and Roth conversion plan for somebody who expects to be in a lower tax bracket in retirement? Well, in general, Roth strategies are pretty complex, and I always recommend people discuss them in detail with their financial advisor and possibly a CPA. But in general, if somebody is in a lower tax bracket in retirement, it usually makes sense to use a strategy called bucket filling to convert traditional IRA dollars into Roth IRA dollars up to a certain tax bracket threshold. This strategy is enhanced if you have a bucket of after-tax money that you can live off of without incurring much of a tax burden from it for a few years when you retire. You can then maximize your Roth conversions without increasing your taxable income past a tax bracket that would be a net negative to your financial plan. A lot of times my clients and I will target the 24% tax bracket because there is a huge jump between the 24 and the 32. You say, oh, it's only 8%, but no, it's actually a 33% jump relative, right? Because you're going from 24% to 32. And that's a massive jump compared to the 10% jump from 22% tax bracket to 24% tax bracket. So you're able to get almost $400,000 of income and still stay in the 24% tax bracket, which gives you a lot of options and a lot of maneuverability if you want to incorporate one of these into your financial plan. Again, I would recommend discussing it with your financial advisor. I've seen people try to take this on their own, and it can get complicated and there can be a lot of mistakes that you would want to avoid. Just be careful before you make any of these decisions. What is the best way to invest money when you don't have a lot? Well, a lot's relative, right? It's really important that once you have identified some kind of surplus in your budget that you can start investing in long-term money, that's when you should do it. And most experts agree that when you're starting out, the most sensible thing somebody can do is invest in broad-based index funds. And you really just need to find one when you're starting out, an S&P 500 index fund, for example, or a world stock market if you want even broader diversification. As far as where should you invest, if you have a job and your employer offers a 401k or other retirement savings plan with a matching component, I would recommend starting your savings here to get as much of the matching dollars as you can. And that way, for every dollar you're putting into this index fund, maybe you're actually getting $1.50 put in. And this will help you build that money even faster. And it may not seem like a lot at first, but over time, it really does matter. And those extra dollars go a long way if you can have them. Does buying the dip work? Well, yes, over time, the market rewards patience and consistency. This holds true for buying the dip. If you have the cash available that you were planning to invest anyway, but you find yourself hesitating because the market has dropped from recent highs, that reluctance is completely normal. But the investors who are able to overcome that fear and put the money into the market anyway are usually very happy they did after a while. And when they look back 4, 5, 10 years later, they hardly even remember that dip. It doesn't look like much of one on the overall chart, but they ended up getting their money into the market at a more favorable price, which has only helped them along the way. How do you know how much money you need for retirement? There are many different free retirement calculators out there for folks who want to do things themselves. A financial advisor can also help you come up with a more sophisticated answer than some of those rules of thumb that are out there. But the most common rule of thumb says you should have about 25 times your annual living expenses saved before retiring. This is just another rephrasing of the 4% rule. And if you want more information on that, go ahead and click here. We have another video explaining it in much more detail. And it's something that's really good to know for any investor as they're getting started. Is dividend investing worth it? So dividend investing is an attractive strategy for investors who need cash flow from their investments. Your investments may go like this over time, but while they're doing that, you're getting a consistent stream of income. And for most stocks, that's once every quarter, they pay a certain amount. And that amount tends to go up over time because most dividend paying companies actually increase their dividends year over year, quarter over quarter, because they know that that's an attractive component for investors and they want to encourage investors to invest in their company. For most people, dividend investing becomes important when you're reaching or nearing retirement, or if you need to supplement your income through your portfolio. The income coming from the investments can either be reinvested into the portfolio to increase the growth over time, or you can take the income for spending and then leave the principal alone to continue growing over time. Now, one important note about dividend paying companies, they typically will not keep up with the market in powerful bull runs. So if you're expecting your dividend portfolio to keep up with, say, a tech growth portfolio in a bull market when things are really, really good, you're gonna be disappointed. But as long as you're okay with maybe not capturing as much of that upside in really good times and you're more focused on a consistent dividend stream, they could be a really suitable investment. All right, I hope you got some value out of this video today. If you're interested in getting a personalized look at your own finances, click the link in the description. We'll review your financial situation in a custom video recorded just for you. Thanks for watching.